In this video, we're going to continue talking about valuing common stock. One of the returns or the things that we get for investing in common stock, one of the things that we get are dividends. So they are payments that are made to shareholders, again, typically from the company's profits. They can be either in cash or stock. And there are different types of dividends. We have regular dividends that are consistent, scheduled dividend payouts, not necessarily constant, that is, not necessarily fixed. They could have some growth, but the idea here is the dividends, regular dividends, are expected. You know exactly what you're going to get the next time, with maybe some growth. There could be something referred to as extra dividends. These are typically one-time profits or one-time payments. The company has some excess cash and they want to distribute it to their ownership. So it is an extra dividend paid out. And of course, it will be announced as such, so as to distinguish it from what regular dividends are expected. There are also, from time to time, maybe some irregular dividends. Again, these could happen for a variety of reasons. Extra cash, maybe we sold off a branch or a product line, and there's cash that needs to be distributed. Most companies have what we refer to as regular dividends. We also have something referred to as stock dividends. This is a distribution of ownership rather than cash itself. And we'll talk about all of these in this video. So what is the source of dividends? What does a company do with its profits? It either pays them out as dividends or retains them and reinvests into the company. So the net income of the company equals the dividend payout plus any amount reinvested, which we refer to as retained earnings. Now, we frequently refer to these in percentage terms. So the payout ratio is dividends divided by earnings, and the retained earnings portion is frequently referred to as the retention ratio. It's 1 minus the payout ratio. There are several dates that are important in the payment of dividends. The declaration date tells us the information about the other dates and information about the actual payment. The distribution date is the date the check is cut for the dividend. But who gets the dividend? For a person to get a dividend, they must be in the company's records on the date of record. On that date, the stock price will, the challenge here is that it takes time for a transaction to close and then show up in the books. So what happens if you buy the stock the day before the date of record? It takes time for that transaction to close, get recorded in the two accounts, your account and the account that it came from, to actually get into the company's records. So they've established what they refer to as an ex-dividend date. It covers this time frame. This is usually 3 days before the date of record. On that date, the stock price will actually fall by the value of the dividend. This ensures that the person that owned the stock on the entire last quarter gets the dividend they deserve. And the person that just received the share does not. So here we see an example of how this might work. On January 2nd, we announced there'll be a dividend of $2 distributed March 1 to all the shareholders of record on February 1st. So if the stock trades between January 30th and February 1st, the stock would actually trade for about $98 on that ex-dividend date. Why? Because the person that you're selling it to gets that $2 dividend. So they're going to get your $98 plus they get their $2 dividend. And you ultimately get the share worth the $98. What do investors do with dividends? To achieve compound returns, they must reinvest somehow in the market. Mutual funds do this as a default. To actually receive the dividends from a mutual fund, you must instruct the fund to actually pay you. Stocks are generally not that way. They will send the shares right to you, the cash right to you. A dividend and reinvestment plan allows shareholders to automatically reinvest their dividends to purchase additional shares. Many blue chip companies offer what are referred to as DRIPs, dividend reinvestment plans, to help long-term investors compound their returns. So suppose you own 200 shares of Johnson & Johnson. It pays $1 dividend. And instead of taking 200 in cash, you just reinvested to get more shares, increasing your ownership over time. Even small investments can grow significantly through compounding. So how we would calculate this, here we have 200 shares. If we have a 60-cent dividend and the stock price is $55, how many shares would you be able to buy? What cash remains? Well, the total dividend, 200, you'd get $120 in the total dividend. The shares you would purchase, you would get 2.18 shares. 2 shares. Typically, you can only get a full share. Now, this has changed recently that you can actually purchase fractional shares. So this actually is a very new innovation in the stock market. So you may actually be able to get the 2.18 shares. So what cash is remaining? Well, in this case, since this 0.18 shares has value, $120 minus the 110, you would actually receive $10 in cash besides this. Now, this does create issues. How can you vote? You can't vote 0.18 shares. So there is some complications when you can buy fractional shares. We'll let the regulations and the financial institutions figure out how that math all works. I did a quick little experiment with this example, though. Assume this happened for the next 5 years with no change in price and no change in dividend. The compound growth over that 5 years would be 4.2%, or a total of 22.8% total return. So if nothing happened to price, there was no growth in price, no growth in dividends, over 5 years, your investment would actually grow on average 4.2% per year. So that is some significant growth over 5 years, 10 years, 20 years, significant amounts of growth in the value. Again, this is assuming no change in value or dividend. A stock dividend is a way for the company to distribute in a, quote, dividend without spending any cash. This is essentially a restructuring of the capital structure. Each investor receives their percentage control, so the value and ownership does not change. So if you owned 100 shares of $20 stock, you have a value of $2,000. Dividend of 10 shares, of 10 shares for each 100 shares gives you 110 shares. If the market price drops from 20, $18.18, as the value of the firm is the same, your ownership is still the same. You have $2,000, that's $110 times 18.18 cents. So what happens is value changes, but your ownership doesn't change because your percentage control does not change. A stock split and stock splits and stock dividends increase the number of shares but do not change the overall value of a shareholder's investment. For example, if Tesla executed a 5-for-1 split in 2020, making its shares a little bit more affordable for individual investors, after the split, the price per share adjusted downward, but the total investment value remained the same. So stock splits can boost liquidity and attract retail investors. Why would a company do this? It's thought that companies trade more frequently in an optimal trading range between roughly $20 and $80. This also allows what we could refer to as a reverse split. Instead of a 5-for-1 split, we could do a 1-for-5 split. This would move the price up, possibly into that range. In the end, nothing happens to the investor because the stock price and the dividend usually split by the ratio. However, what happens if they don't? Then value is created, but not taxable value. Remember that returns have to be recognized to be taxed. Companies often buy back their shares when they believe the stock is undervalued or if they have some excess cash. For example, Apple's been a leader in share repurchases, buying back billions of dollars worth of its stock. This reduces the number of shares outstanding, increasing the value of each remaining shares. It also provides some flexibility compared to dividends, as companies can adjust them based on cash flow conditions. So why would a company do this? Can be like a cash dividend, as each remaining share is worth more. The company can hold these in treasury, use them for management options. They can also use them to buy other companies. They could use it to protect themselves from the takeovers of stock. The important part to understand about stock repurchases is that they are taxable, just like all cash distributions are taxable. So dividends, the cash dividends that you receive are taxable. Stock repurchases are taxable. Stock splits and stock dividends are not taxable because you really don't get anything. All you're doing is changing or recapitalizing the equity section of the balance sheet. The next several slides, we're going to talk about ratio analysis. Financial ratios help investors assess a company's performance and financial health. They provide answers to critical questions, such as can the company meet its short-term obligations? These are liquidity ratios. How profitable is the company? profitability ratios. How efficiently does it use its assets? These are activity ratios. And we'll use a few examples as we go along. But there's a variety of ratios. Depends on the industry. It depends on the competitors of how we analyze all of these numbers. We can look at time series. How has the ratios changed over time? We can also use cross-sectional analysis. We compare the company's ratios to competitors or to the industry at a certain point in time. So the first set of ratios we look at are what are referred to as liquidity ratios. They measure a company's ability to meet short-term obligations. The current assets are those things that can be turned into cash within 1 year. Current liabilities are those things that are due in 1 year. So current assets reflect near cash. Current liabilities reflect, in quotes, near bills. So if current assets are greater than current liabilities, that is, if the current ratio is greater than 1, we have more cash than we have bills, so the company has liquidity. And the bigger the numbers here, the greater the liquidity. The quick ratio gives us a more conservative view by subtracting out inventory, because inventory is a little bit harder to convert into cash than accounts receivable is. So for this company, we have a current ratio of 1.74. It is just the current assets, and in 2021 here, whatever this year is, just 2,046 divided by 1173. That gives us the 1744. The quick ratio, likewise, 1.19. Both of these numbers are greater than 1, so it implies that they can pay their obligations quite easily. Now, the quick ratio will always be lower than the current ratio because the company has inventory. The bigger the inventory number, the lower this number goes. The quick ratio can go below 1 and not necessarily reflect a problem, because as long as the current ratio is greater than 1, we should have more cash than bills. But if the company has a lot of retail, for instance, if a company has a lot of inventory, if it is retail, a substantial portion of total assets is inventory. So this number could fall dramatically. It could be as low as maybe 0.2 or 0.3. That is okay as long as we understand the business and as long as current ratio remains above 1. Activity ratios help us look at how effectively the company uses its assets to generate sales. Amazon's high turnover ratio is a result of efficient supply chain. That ensures products move quickly from warehouse to customer. High turnover ratios are generally favorable, as it indicates inventory management and sales performance. These ratios represent a short-term and a long-term view. Inventory and receivables are short-term and tell us how the company might be handling their cash flows. Long-term ratios look more for our choices of assets. Did we choose the correct assets and the correct amount of assets? So here, as we look at our ratios, we set the inventory turnover ratio of 10.2, which means we are buying and selling our inventory 10 times a year. Now that number is a little bit difficult to really visualize, but it does give us a little bit of a view of how quickly it turns. it would have been nice if we could have had the year before to know whether our inventory turnover was increasing or decreasing. For accounts receivable, they give us a little bit of a different formula. And we see here that the most recent year, we turned over our accounts receivable 20 in 23.65 days, and our customers paid us back last year 24.75 days. So this shows that we're getting our money back quicker by a little bit more than a day. Does a day make a difference? Well, if you take these numbers and multiply them by 100 million, for instance, because that's the size of some very large corporations, having an extra $100 million in your checking account for an extra day is a substantial cash flow. You can also see that receivable turnover increased, which meant what? That we're getting our money back quicker. Our fixed asset and total asset turnovers, again, show that we actually showed some decline. So for some reason, we have lost some of our efficiency in managing our total assets and our planted equipment. So again, we may want to analyze in our company, if we're managing this company, what's going on with our assets. Do we have too many assets? Is there a reason for this slowdown of efficiency? Again, as we talk about these ratios, it is a far more complicated analysis and process. This is just a real cursory kind of view. So you're not really expected to understand all the implications here. But this is one way that investors analyze a company to try to predict what's going to happen in the future. See you in the next video.